Greetings, candidates, and welcome back to the Advanced Financial Management class. Today we continue with the topic mergers and acquisitions. So far, we've studied the nature of mergers and acquisitions. We discussed the arguments for and against the use of mergers. We went ahead to highlight some of the evaluation models, the defense tactics against hostile takeovers. Today we move on to the next subtopic, which is financing of mergers and acquisitions. Now, after the evaluation of a target, the company has to figure out which method to use to finance the acquisition. And there are various ways. The company can choose to do what we call outright purchase using cash. There could be share for share exchange, share debenture exchange, and share preference exchange. In this lesson, we're going to discuss the various methods that can be used in financing mergers and acquisitions. And the first method is outright purchase using cash. Outright purchase using cash. The second method is share for share exchange. Number 3, we have the share debenture exchange. Share debenture exchange. 4 is the share preference exchange. Outright purchase using cash, number 1. Number 2, share to share exchange. Number 3, share debenture exchange. Number 4, share preference exchange. In this lesson, we're going to highlight the advantages and disadvantages of these methods. We're going to also discuss how the methods can be used. First of all, let's begin with the share purchase using outright cash. Share purchase using outright cash. After valuation of a target, the acquirer may decide to pay or to purchase the target using cash. So when discussing the financing of mergers and acquisitions, an outright purchase using cash refers to the straightforward transaction where the acquiring company pays for the target company entirely with cash. Entirely with cash. If the agreement is, say, 100 million, the acquirer pays the 100 million transaction in cash. Straightforward. Do you understand? So the target company shareholders receive immediate cash. They receive immediate cash payment for the shares. They receive immediate cash for their shares. So shareholders of the target company receive immediate cash for their shares. They receive immediate cash for their shares. So that is one feature of outright purchase using cash. It is a very simplified transaction compared to other financing methods like stock swaps or cash acquisitions, and cash acquisitions tend to be simpler compared to share, compared to share debenture exchange, compared to share preference exchange. This one is simpler. It is a simpler transaction. It's like going to a yard and just paying for a car, or going to a market and you pay for a commodity. It is simple. You pay the seller and the transaction ends there. There are very few complexities related to valuations and potential fluctuations in stock prices. Another aspect here is control and ownership. Control and ownership. The acquiring company gains full control, full and immediate control of the target company. And there is no dilution of ownership. There is no dilution of ownership for the acquiring company's existing shareholders. Control and ownership is immediate. Financial resources. This method requires financial resources. For the target company to effect this transaction, for the acquirer to effect this transaction, then the acquirer has to have financial resources. Financial resources. The method requires the acquiring company to have substantial cash reserves, or the company should have the ability to raise significant capital. You understand? So this method comes with the advantages, what we call pros, and disadvantages, what we are calling cons. Now, the first advantage of financing of mergers and acquisitions using outright purchase using cash, is certainty for the seller. Certainty. Certainty is an advantage for the seller. The target company shareholders receive immediate and guaranteed payment. Immediate and guaranteed payment, which then eliminates uncertainties associated with stock fluctuations. There is that element of certainty. Simplicity. Speed and simplicity is another advantage. Speed and simplicity. Here we say that is a simple transaction. Cash transactions tend to be quicker and less complex than those involving stock exchanges, like the share-to-share exchange, the share debenture exchange, and so on. Simple and quick. Speed and simplicity. Clear valuation. Clear valuations. Now, how is clear valuation an advantage associated with the outright purchase using cash? Now, the price is clearly defined. Before the payment is done, the price is clearly defined. Clearly defined, which reduces then valuation disputes. Clear valuations reduces valuation disputes. Maintains control. Is also an advantage associated with control. Control. The acquiring company retains full ownership and avoids diluting its existing shareholding or its existing shareholders' equity. Another advantage is positive market perception. Positive market perception. Positive market perception. How is positive market perception an advantage? Positive market perception. How is it an advantage? Now, candidates' cash deals can often signal financial strength to the market. When the market hears that company A has acquired company B with an outright purchase using cash, then it sends a signal, an indicator that company A is doing well, and investors would want to be associated with companies that have strong financial muscle. So these are 5 advantages. But you also have disadvantages. There are some disadvantages that are associated with the financing of mergers using outright cash. One is financial strain. It can lead to financial strain, particularly where the target is overvalued. Large cash outlays can deplete the acquiring company's financial reserves, which then potentially hinders future investments or operations. Opportunity cost. Opportunity costs. Using cash for acquiring a company means that those funds are unavailable for other potential uses, such as research and development, such as expansion, and so on. Funding requirements, number 3. Funding requirements. If the acquiring company lacks significant cash, it may need to borrow. It may need to do what? To borrow. It may need to increase debt. Then that leads to what we call debt load. And debt load, we know, is associated with the interest expenses, which are fixed. That is a disadvantage. The company lacks money from its internal sources, then the acquiring company may be forced to borrow, and that increases its debt load, and it increases the interest charges that are associated with debt. Funding requirements. There could also be tax implications. Tax implications. For the seller candidates, receiving cash creates an immediate taxable event. Okay, there is an immediate taxable event, and that could lead to capital gains taxes, which will be due to the seller. So that is all we can say about outright purchase using cash when financing mergers and acquisitions. So this is the first method. Now the second method is share-to-share exchange. Share-to-share exchange. B, share-to-share exchange. Share-to-share exchange. Share-for-share exchange is another method that a company may use to finance mergers and acquisitions. Now, when discussing the financing of mergers and acquisitions, a share-for-share exchange is a crucial method to understand before settling on which method to use. Companies have to consider the share-for-share exchange method. And in essence, share-for-share exchange is a transaction where the acquiring company offers its own shares to the shareholders of the target company in exchange for their existing shares. Share-for-share exchange. It's self-explanatory, is it not? The acquiring company offers its own shares to the shareholders of the target company in exchange for their existing shares. So if company A is acquiring company B, so this is the acquirer and this is the target, the predator. This company has shareholders, this company has shareholders. This company is buying company B. This company B is owned by existing shareholders. So instead of paying the existing shareholders cash, as we saw in the first case, this company can offer its own shares to company B. Because once company B is acquired, this company ceases to exist. So instead of these shareholders being granted or given cash, they become shareholders of company A by virtue of the shareholding that they receive in exchange to their existing shares. So they have to relinquish their own shares in company B, and for them to relinquish these shares in company B, they are given company A shares. The acquiring company offers its own shares to the shareholders of the target company. And that is in exchange for their existing shares. So they are not given cash, they are given shares of company A, the acquirer. And that means that instead of receiving cash, the target company's shareholders become shareholders of the acquiring company, to put it differently. And a critical element here is the exchange ratio. Okay, there has to be a ratio. A critical element in share for share exchange is the exchange ratio, which determines the target company. You understand? The exchange ratio, which we will be learning how to calculate later on. But you have to get that understanding. You need to understand what is a share for share exchange. Now, one of the key features of share to share exchange is that it is equity based. This method is equity based. We are talking about share to share exchange. It is equity based. It's based on equity. The method primarily involves the exchange of equity rather than the exchange of cash or debt. Another feature associated with what is dilution. Another feature associated with the exchange, the share to share exchange, is dilution. Now, the acquiring company issues new shares, which then dilutes the ownership percentage of its existing shareholders. If, for example, there were only 10 shareholders, when new shareholders are introduced, say 20 shareholders are introduced, then there is dilution of shares. There is dilution. The existing company, after issuing new shares, dilutes the ownership percentage of its existing shareholders. So these ones were holding equally, say equal, maybe each is a tenth of the shareholding. When you have 20, they will no longer be controlling, each shareholder will no longer be controlling 10%. The percentage will be diluted by virtue of having many shareholders in the company. Dilution. Another feature associated with the share-to-share exchange is the aspect of valuation. Valuation. Accurate valuation of both companies is essential in order to determine a fair exchange ratio. The companies must be properly valued in order to have a fair exchange ratio. There could also be tax implications. In some jurisdictions, this type of exchange can be structured to be tax deferred, which can be a significant advantage. Now, why would a company then prefer share-to-share exchange and not outright cash or share-to-debenture exchange? Why do we have some companies preferring share-to-share exchange? That is a question that we may want to answer. Companies use share-to-share exchange in mergers and acquisitions for various strategic reasons. And the reasons are structured around financial flexibility. They are structured around alignment of interests and also tax advantages. One reason is to conserve cash. Companies would prefer share-to-share exchange as opposed to outright purchases in cash in order to conserve cash. That is the primary reason. The primary reason a company will opt for share-to-share exchange is to conserve cash. Instead of paying cash for the target company, the acquiring company offers its own stock. And that is especially important for companies that want to preserve their financial resources. So that instead of paying the target company, that money can be invested. That's one reason. Another reason is associated with large acquisitions. Large acquisitions, another reason. Now, large acquisitions, a cash purchase might be prohibitively expensive, which makes share-for-share exchange a more viable option if you have a large acquisition. If the target company, if the acquirer is to pay large sums of money to the target, the only viable solution will be share-to-share exchange. Yet another reason is aligning of interests. Aligning of interests. Aligning of interests. Now, when the target company shareholders, for example, receive shares in the acquiring company, they become shareholders in the combined entity. And that aligns their interests with the acquiring company's interests, which then encourages them to support the integration process. You understand? Yes. Because they are now part of the ownership of the acquiring company. To align the interests of both the target company and the acquiring company, the share-to-share exchange method is preferred. Tax advantages. Now, candidates, in some jurisdictions, a share-for-share exchange can be structured as a tax-deferred transaction. It can be structured as a tax-deferred transaction, which means that the target company's shareholders do not have to pay capital gains taxes until they eventually sell the shares of the acquiring company. Deferred. That's why I refer to it as deferred. It is a tax deferred transaction. Tax deferred transaction. Because it is a share to share exchange, the shareholders of the target, as opposed to the cash method, they are not required, may not be required to pay capital tax gains after selling off the company. They may be required to to pay tax gains after selling the shares that they receive from the acquiring company. So that is another reason. There are no capital taxes, capital gains taxes that are paid when this transaction is being carried out. And that is a tax advantage. That tax advantage is attractive to the shareholders. It makes the deal more attractive to the target company's shareholders because it allows them to defer paying taxes on their gains. They gain by joining the acquiring company without making any taxes, without paying taxes. So that's an advantage. That is a reason. Reason one is conservation of cash. Number two, we've said it aligns the interests of the shareholders. Number three, we've seen it has tax advantages. Number four, the fourth reason why share-to-share exchange is attractive is flexibility in negotiations. There is flexibility in negotiations. Offering shares can be a flexible transaction tool, allowing companies to structure deals that meet the needs of both parties. Because using shares can help when there are disagreements on valuations. If there are any disagreements on valuations of both the companies, the disagreements can be resolved when financing using share-to-share exchange method. You understand? It allows for flexibility in negotiations because the target company shareholders are not being paid off and they go away. No, they still become part of the new entity. They become part of the shareholders, the owners of the acquiring company. So it becomes very easy to negotiate or to iron out any disagreement that may arise during valuation. Understand? There is also another reason. It maintains financial stability. Financial stability is maintained. You understand? Share for share exchange prevent the acquiring company from having to take on large amounts of debt. So these are the advantages. These are the reasons why share to share exchange is preferred or may be preferred. But does that not mean that this method does not have disadvantages? There are also some disadvantages that are associated with or challenges that are associated with the method. So what are the disadvantages? Now the first challenge of share-to-share exchange method is dilution of ownership. Dilution. It's obvious. Dilution of ownership. Issuing new shares dilutes the ownership stake of the acquiring company's existing shareholders. That is obvious. There could also be valuation challenges. 2, valuation challenges. Valuation challenges. Determining a fair exchange ratio can be complex and contentious because it requires accurate valuations of both companies. And there could also be fluctuations in stock prices which can further complicate the process. Market volatility is another disadvantage. Market volatility. The value of the shares received by the target company's shareholders can fluctuate, which creates uncertainty and potential losses. Complexity. Is a challenge. How is complexity a challenge? Share for share exchange can be a complex transaction which requires careful legal and financial planning. There is dependence again on stock performance. E, dependence on stock performance. Dependence on stock performance. The value of the deal is tied to the performance of the acquiring company's stock. And if the stock performs poorly, then the deal becomes less valuable to the shareholders of the target company. So candidates, that's all we can say about the share to share exchange. We highlighted the features, the advantages and the disadvantages. Let's move on to the fourth or the third method. The third method, that is C. Share debenture exchange. Share debenture exchange is yet another method that can be used in financing mergers and acquisitions. Now, a share debenture exchange refers to a financial transaction often occurring during mergers and acquisitions where a company offers a combination of its own shares and debentures to the existing shareholders of another company. And at this stage in your professional journey, I know you have you fully grasp the meaning of a share. Shares, we know, represent ownership in a company. When you hold shares, you own a portion of that company. So shareholders may receive dividends, which is a portion of the company's profits, and may have voting rights. That is the meaning of share. A debenture, on the other hand, these are debt instruments. They are essentially loans that are issued by a company. And debenture holders are creditors and not owners, like the shareholders. They are not owners, they are creditors to the company. And they receive fixed interest payments. Debentures, something to note again here, are essentially unsecured. They are typically unsecured, meaning that they are not backed by specific assets. And therefore, a share debenture exchange involves providing the target company shareholders with a mix of ownership and debt in acquiring the company. In the acquiring company, that is. So the existing shareholders of the target, after the deal, they are given a mix of ownership and debt in the existing acquiring company. You understand? The share debenture exchange, I repeat, involves providing target company shareholders with a mix of ownership, which is represented by shares, and debt, which is represented by debentures in the acquiring company. And this strategy candidates can be particularly useful in mergers and transactions because it offers a blend of potential for capital appreciation through shares and stable income stream through debentures. You understand? By having a mix of shares and debentures in the acquiring company, the shareholders of the target company can enjoy the benefits that come with capital appreciation, but they also enjoy some level of fixed interest payments because of the debentures. So the question we need to ask, why companies use this method? We know companies use share debenture exchange for various strategic reasons. And one main reason is to offer a more appealing and flexible deal structure. So one reason or advantage is to attract a wide range of investors. Attract wide range of investors. To attract a large or wide range of investors. This method appeals to investors with varying risk appetites, because we've seen that debentures offer a stable income stream through interest payments, while shares provide the potential for capital appreciation. So you may have investors who are looking for both capital appreciation and the potential for the fixed interest payments. Flexible financing. It is a flexible financing method. There is flexibility. The share debenture exchange allows for a greater flexibility in structuring the mergers and acquisition transaction, because companies can tailor the mix of shares and debentures to meet the specific needs of the target company's shareholders. 3, there is a reason in relation to the lowering of interest costs. Lowering interest costs. Often candidates, the debentures offered are convertible. The debentures that are offered to the shareholders of the target company are convertible debentures, meaning that after some time, the debentures are converted into shares. They can be exchanged for shares at a later date. That's the meaning of convertible debentures. The debentures that are mostly used in these transactions are convertible debentures. And this conversion feature can make debentures more attractive to investors, which allows the acquiring company lower interest rates. Deferred equity dilution. deferred equity dilution. Deferred equity dilution. What does that mean? Now, the equity dilution from issuing new shares occurs only upon conversion of the debentures. So if debentures are converted after 10 years into shares, then the dilution is deferred. Dilution can only happen after 10 years. That's an advantage. That's an advantage. Deferred equity dilution. And that allows the acquiring company to manage the dilution over time. Next, bridging valuation gap. Another reason why this method is attractive is the aspect of bridging valuation gap. Bridging valuation gaps. In situations where, for example, there is a disagreement there could be a disagreement on the valuation of the target company. But you see, this method is offering a mix of shares and debentures which can serve as a compromise. Number 6 is provides income and growth potential. Provides income and growth potential. This method provides income and growth potential. Income and growth potential, and it's more appealing to investors. So this aspect provides income via the debentures and growth potential via the shares or the conversion of the debentures into shares. So a share to debenture exchange comes with the advantages. 1, attracts wide range of investors. Number 2 is flexible financing. Number 4 is lowest interest cost. There is the deferred equity dilution. It bridges valuation gaps. It also provides income and growth potential. There is potential for income through the debenture interest payments and potential for growth through the shares that are offered to the shareholders of the target company. All right. Now let's move on to the last method, which is the share preference. The share preference. The share preference share exchange. Share preference share exchange. The share, this is the ordinary share, this is the preference share. The share preference share exchange. The share preference share exchange. Now, share preference share exchange in the context of mergers and acquisitions. In the context of mergers and acquisition, the share preference share exchange, what does that mean? What does it mean? Or what does it involve? This one currently involves offering preference shares of the acquiring company to the shareholders of the target company in exchange of the existing shares. So the acquiring company offers its preference shares to the target company shareholders in exchange for their common shares in the target company. And this exchange provides the target company shareholders with a more stable and predictable income stream, because we know preference shares the preference shareholders are paid fixed dividends. All right. And if the preference shares are convertible, there is also the ability to convert the preference shares at a later date into common shares of the acquiring company. And there are very many reasons why companies also prefer preference share exchange. Companies use the preference share exchange in mergers and acquisitions for various strategic reasons. And the main reason is to appeal to specific investor preferences and to achieve certain financial objectives. One reason is to attract conservative investors. One reason is to attract conservative investors. Now, preference shares offer a fixed dividend, providing a predictable income stream. And this is attractive to investors who prioritize stability over high growth potential, such as retirees or risk-averse individuals. It may also reduce risk. Preference shares have a higher claim. The preference shareholders have a higher claim on dividends and assets in liquidation than common shareholders. So reduces risk. Reduce risk to the investors of the target company. It may also facilitate M&A deal or transaction. Understand? Offering preference shares can make the M&A transaction more appealing to target company shareholders who are maybe hesitant about the volatility of the common stock or who desire a more stable income. There's the aspect again of bridging valuation gaps. Bridging valuation gaps, which I explained earlier. This method can help bridge valuation gaps. Right? Bridging valuation gaps. Another point is related to capital restructuring. Capital restructuring. This method can be very essential in capital restructuring. Adjusting capital structure. A company may use share exchange to adjust its capital structure, potentially reducing the number of outstanding common shares or even altering its dividend obligations. There could also be tax considerations, as explained earlier. Tax considerations. Depending on the jurisdiction, there may be tax advantages associated with the preference shares that make them attractive to certain M&A scenarios. So there are many reasons, candidates, why preference share exchange may be preferred in mergers and acquisitions. So in this lesson, we've discussed the 4 methods. One is outright purchase using cash. These are methods in financing mergers and acquisitions. The second one is share-to-share exchange. The third one is share debenture exchange. And lastly, we've discussed preference share exchange. Thank you for attending the lesson. We continue to learn more about mergers and acquisition in our next session. Bye-bye.